So you just had your fireside chat to the 2,000 plus participants here at the summit. What was your main message? I mean, there's a lot going on since the last time you and I talked a year ago here.
Well, I think the main thing, and the main concern for everyone is the America-China relationship. I've been coming to China since like 1993, and it was all bicycles outside. Most of these buildings weren't here. Enormous progress. China is going to raise. They're rising peacefully. It's a good thing. It's making their neighbors a little nervous, which they need to understand. And but around trade, you know, we point out the president's raised some legitimate issues around trade. But the better thing to do is sit down, really understand each other, talk about how you can improve it, make it a win-win for everybody. And I think that's achievable. So I applaud the fact that recently they've been having more detailed conversations on both sides. And I gather they can continue next week in Washington.
Liu He is going to Washington next week, but the general consensus, at least publicly, was that the talks last week in Beijing with Steve Mnuchin and Wilbur Ross did not bear much fruit.
Yeah.
Are you disappointed by that?
No, I think that they're just getting to know each other, and there are some very complex issues. And they laid out, which I think is good, they laid out what they want from the American side, and the Chinese side laid out what they want, and that's how you start the conversation. And now they're working on specific things. What do you mean by that? And so hopefully they'll make progress. We need there to be progress to be made.
Do you think a trade war is possible?
It's always possible, but it's not the preference for. I hope it's not the preference for either side.
Yeah. Do you think their list of demands are too far apart, though? It's going to take quite a while.
No.
No?
No. I think when you go to trade, you talk about intellectual property or tariffs or equity caps and where you can invest and how you protect investments, and it gets into a lot of detail, but there's no reason it can't be bridged. And if both sides have good faith, if they don't, then it may not be bridged, and then you have a different economic relationship between the United States and China.
You believe there's good faith? I know Stephen Roach, formerly of your competitor, he says that the U.S. approach has been all stick, no carrot.
Yeah, I don't know about that. I mean, like I said, the president's laid out certain issues that a lot of the business community would agree with around equity caps, transfer of property, non-tariff barriers. And I think the Chinese know that some of those are true. But they're not going to give in to anything if they know exactly what the deal is going to be or something like that. The President, Trump, would also say he's got a great relationship with President Xi. They built up a bond of trust, that he wants some of these trade things fixed. And our President has laid out some very tough things, but he's also negotiated. In other cases, I pay a little less attention to tweets, a little more attention to what are they negotiating, what's on the ground. They did a free trade deal with Korea.
Mm-hmm. They're negotiated it.
Yes, and they're talking about, from what I hear, they're talking about having an agreement in principle on NAFTA, hopefully next week or two. So, it is doable, and I think both sides do want it, so I do think there's goodwill there.
Do you think Trump is getting the best advice on how to handle China? The Business Advisory Council, which you were a part of, has been disbanded. Is he getting the right advice?
So the Business Roundtable, which I'm the chairman of, is not disbanded,
yeah.
And we've given some
was.
very specific advice about what the issues are, how we think they should be resolved. We are not in favor of tariffs and tit for tat. The issue with that on trade is it always can start this kind of political response and nationalistic response and kind of a snowball effect in a bad way. No one wants that. Sit down and negotiate the deals. And I don't know the advice inside. I don't agree with some of the advice he gets from someone like Peter Navarro. I just don't agree with it. And but he talks to a lot of people, the president. Hopefully he's understanding the issues in a way that they can go negotiate a successful transaction.
Now, when you and I talked last year, of course, we were talking about your position here in China. You got out of your joint venture with First Capital Securities. You were hoping eventually down the road to get 100% ownership of a venture in China. Now, of course, we've had these announcements that as of June 30th, we're going to have a liberalization and opening up in securities. Foreigners can take the majority stake, 51-49. Is that enough to get you back in, or do you want further liberalization?
Oh, no, that was always the full intent.
Yeah.
That what we want is simple: 100%, and all the licenses do the same business we do in the United States: debt, bond, equity, trade, and research. And I think that's better for the Chinese. I mean, joint ventures, a lot of these are hard to govern, badly run, not very successful, don't set the highest standards, and don't bring the best all of JPMorgan. For example, where's the research get done? And if you sell something somewhere, you can sell it here, but you can't sell it there, and you have to negotiate the fees with the joint venture partner who doesn't necessarily understand our business. Once we have a 51% and then 100%, you don't have the full faith of JPMorgan coming here. Training, recruiting, credit, capital, product, services. We bring multinationals from around the world here. We bring Chinese multinationals outside. We represent some of them. So, we're optimistic we'll get there. We have regulators on both sides of the world we have to deal with. And so that's part of the process to making sure that's all aligned properly.
Do you see that this is the step-by-step process? Go to 5149, and then maybe after 3 years they allow full 100% ownership?
Yes.
Yeah. So where are you in that process of jumping back in?
We're on the process. Yeah.
By when?
When we have something announced, we'll tell you.
I mean, what's your time frame?
As soon as possible.
As soon as possible.
I'm not worried about it. I mean, hopefully it'll happen. But like I said, I have regulators all over the world. So when it comes to JPMorgan, we're going to make sure we get all the ducks in a row.
Right. What's the key priority, though? Because when we did talk last year, you said joint ventures by nature are sloppy corporate governance. That must be a key concern of yours.
Yeah. But at 51% control, where you know the other owners and you have a path to ultimate control, that's a whole different thing. And that actually works.
How involved have you been in the consultational period for the securities joint venture framework? I know there's been some concern raised by an industry body in Hong Kong about the practicality of new rules informing these securities joint ventures, particularly like $100 billion in net asset value and other requirements.
I'm not worried about it.
No.
I think when people put out very complex rules, I think the intent was real, and obviously if there's complex rules, and some of those will probably be changed over time, and our people have been in constant contact and think that we'll be able to work out all those things.
Now, the People's Daily, I believe it was last week, the mouthpiece of the company.
And remember, the point of some of that is that these are properly capitalized companies. Yeah. Obviously, JPMorgan is a properly capitalized company. Yeah. So if you were running a securities business, you want to make sure that what comes in and gets done is done right. So I look at those rules, and they're just trying to get it right.
Right. By what time frame with these liberalizations do you expect foreign banks to really see significant material increases in revenue and profits in China?
I don't think that's certainly not the way we look at it. We're building here for 100 years. Right. And as China grows, we'll grow with their companies and with their companies, and some of the state-owned enterprises will go public. They'll be doing more and more multinational business, more and more multinationals coming in. So we're gearing up for that. So over time, that's hiring bankers and traders and risk and legal, credit compliance, audit, communication staff. So one day, we'll probably have a tower here that looks like the tower we have in New York. Multiple trading floors. We already do research on 300 companies. Now it'll be 500, 700, 1,000 of China desks serving Chinese companies in Brazil and Germany and France and the UK. That's how we're going to build it. I really don't worry that much about when we're going to see revenue benefits. That's not how you...
Your tower in China will have fewer logistical headaches with the new one in New York.
Fewer bureaucrats.
People's Daily was out with a commentary, I believe it was last week, saying this liberalization for foreign banks and foreign institutions in the financial sector will basically only be available to those who do not practice protectionism and those who do not violate WTO rules. Now, in this trade spat, China has accused the United States of violating the WTO and also of being protectionist. Are you concerned or getting any indication that perhaps banks like yourself?
I think that's mostly political talk, okay? Like the WTO, and I've been public, it's slow, it's anachronistic, people are standing behind it. You can accuse a lot of people of not violating WTO. Look, hopefully that we don't have a trade tiff, and hopefully it doesn't affect JPMorgan. I don't know any more than you do whether that's the truth or not. That's my goal. Let's get the trade stuff done. Let's let JPMorgan do its thing. If China wants to retaliate against whatever country it wants to, it can. So can America. So that's just, people threatening each other isn't going to accomplish anything, in my opinion.
Yes. How do you see global markets right now? I mean, we're heading into a bit of volatility after the beginning part of the year. It doesn't look like, at least in the United States, that the tax cuts have necessarily fed into the real economy completely yet, and there's a lot of concern.
Yeah, so I was sitting here for years and everyone's worried about what is the growth, is sector stagnation, deflation forever. Now we're starting to grow around the world and everyone's worried about the other side. Yeah, right. Too much growth, too much inflation. I mean, people should take a deep breath. Volatility is a part of a market. Sometimes it's not, and sometimes it is. Sometimes it's bad volatility, sometimes it's good volatility. And I don't worry, again, I don't worry that much about it. I like the fact the world is growing. We're going to lift more people out of poverty. Wages are going to go up in the United States, which we need. And then the taxes, I think people are not thinking clearly. America needed a permanent competitive tax system. The lack of a permanent competitive tax over 20 years damaged America deeply. America is so strong, they didn't really see a lot of that. But in my opinion, it was significant. Hundreds, thousands of companies moved overseas. A lot of plants were built overseas. Now we're competitive. The immediate effect is not that big. It was never intended to be that big. The immediate effect is, we're going to open more branches and people raising wages and doing more things and more for them, and that's good. Yeah. The real effect is the accumulation and reinvestment of capital in the United States for the rest of our lives. that is a huge positive effect. And it will never be able to show you the counter effects about the positive it had. But I can prove to you some of the negatives of having it the other way around. And I also don't like this argument somehow we shouldn't have done it now because things are good. You should have a competitive tax system in good times and bad times. That's what we should have had. It hurt us dramatically not to have it. Now we have it. And I think it's going to be a very good thing, and it'll accelerate growth over decades.
Now, I know you don't like to talk the short term, but how much do you look at that 10-year Treasury yield breaking 3% or the flattening of the yield curve, possibly inverting, signaling that this recovery does not necessarily have legs?
I just don't agree with that. First, I think 2.99%, 3.0%, who cares? I mean, it's a mindset. It doesn't mean anything in and of itself, and nor does 25 basis points in the change in funding cost, something like that. You always have to ask the reason why. So if rates are going up because we have growth, there's more demand for capital, that's a good thing. And so I think rates will be going up. I don't think the curve's going to invert. Personally, I think the 10-year bond will go up. We already have inflation at 2%, which was which was the Fed's target, and those are all kind of what we wanted. So we should applaud that, and so I'm not that worried about it. If you had the thing to worry about would be something like stagflation, where all of a sudden you have rampant inflation and no growth. That's the worst thing for the world.
Right.
And so right now we have real growth. Wages. We said we want wages going up. We should applaud that.
We were just talking as we went into a break about the sustainability of the U.S. recovery. You believe that it is. No matter what you read into the possible inverting of the yield curve or the 10-year Treasury going above 3%, you still think this is a long-term sustainable recovery? Well,
I know. So someone asked me once about what's the odds of a recession. I said it's 100%. But the question is when, and right now the American economy in a very broad-based way is strong. More people are going back to work, household formation is going up, houses in short supply, which is a plus for the economy. The capital markets are wide open. There's much less leverage in the financial system than the past. And I disagree when people say it looks like 07. Banks have twice the capital, twice the liquidity. The consumer balance sheet's in very good shape. So America looks pretty good. But the way to look at the recovery is look beyond a year. We've had 20% growth over 9 years. Yeah. And the 9 years is really good. The 20% is really bad. It should have been 40% over a shorter time period. And that is part of the reason why wages didn't go up and all these various things. So it looks like this may have legs to go. Maybe a year, maybe two, maybe more. Just because other things happen a certain way, it won't happen exactly the same way. So no. And remember, and the rest of the world's also doing better. Japan, 1.5%. Brazil, -4 to +2. Europe, 1.5 or approximately. And China.
Japan getting out of its funk?
I don't know, but it's 1.5%. Yeah. A year for the last 10 years, it was 0. So that's a positive. I hope it'll continue. But the fact is, all I'm saying is America's in pretty good shape. And then you've got some benefit of regulatory reform, some benefit of tax reform. And I think those things will drive growth a little bit, and hopefully better than 2%.
Now, I read your note to clients in April after the quarterly earnings. You said one of the biggest risks is underestimating the ability or the potential of the Fed raising rates more aggressively. Yeah. Inflation could rear its head. We just had oil above $70. I mean, is this a worry?
I was trying to explain to my shareholders that you got to prepare for all possibilities and probabilities. So there is a possibility that growth accelerates, that inflation accelerates. It's higher than you expect. The Fed raises rates a little bit more than you expect, both in the short end, in which my opinion might force the 10-year up, not down like in the past. And so you can easily deal with 4% bonds. And I think people should be prepared for that. Again, if it's because America is strong and healthy, I would call it almost more like normalization. The other thing I pointed out is by the end of the year, the government in total, the Fed plus the deficit, we have to finance $400 billion a quarter. Mm-hmm. That's a lot. That's a huge shift in the past. And eventually the other central banks of the world will reverse their buying of bonds. And those things may cause more volatility, higher rates, in a way we don't fully understand because we never had QE, we've never had the reversal. Yeah. But again, as long as the world growing is more important than that. Okay, and so I always try to keep a view on both. The financial markets are one thing, they fluctuate, they move, rates go up or down, commodity prices go up or down, but what matters to most of the world, including the governments, is jobs, wages, stability in the economy, not necessarily in the markets.
Speaking of the bond market, let's talk about the Chinese bond market. They have made strides to opening up the $10 trillion bond market to foreign investors. They also recently started oil futures trading in yuan. With moves like this, when do you see the renminbi taking a much larger, if not a comparable role internationally with the dollar?
I think the way you should look at that is that eventually it will be comparable. Eventually it's 20 or 30 years. It's not comparable if it's not convertible. Right. So being part of the SDR, being MSI, these are small adjustments and they're good. I applaud the Chinese for doing it. But until you can buy and sell securities freely, if you have a US dollar, you can buy and sell securities freely, then that's a big thing. They're on the path. But that's really related to the whole economy and opening up, not just these moves, et cetera. And the bond market is critical. You know, if you want a healthy financial system, you need healthy bond markets. A lot of the bonds now are government or state-owned enterprise, which are effectively government guaranteed. Right. But you need around real bonds or real companies, transparency, governance, collateral rules, rule of law, open trading, proper research, proper credit agencies, all these things which create a really healthy bond market. And again, they're on the way, but they still have quite a way to go.
Now they're also on the way to the MSCI Emerging Markets Index for the stocks, A shares.
In a very small way.
Very limited, 232.
Because they can't do it in full size because they don't allow people to buy the stocks in that size. So,
how are the flows going to be?
It'll be a plus. But again, I put that as a very minor adjustment. It's a nice thing. It gets the world more educated about China. But in terms of actual dollar amount, it's not. I think it was 5%. You know, and I've got the estimate of how much money that might be. It's not going to be earth-shattering to China or to anybody else. But because it's the MSCI, everyone who studies the MSCI is going to be studying China. I think that's a very good plus for China. Eventually, to make it the full share of stock, and where it's, you know, I think the stock market is 30% the size of America's or something like that, they're going to have a convertible currency. That's quite a ways away.
What else keeps you up at night? Cybersecurity, you called it in your note to the clients, an arms race. How big of a threat is that?
It's the biggest risk facing the financial system in the world. I beg my regulators, you know, we got to be forward-looking. It's got to become part of trade. It's got to become part of what I call geopolitics. Like, what are you allowed to do? Think of maritime law, aviation law. Very strict rules. The countries have courts and responsibilities. That there'll be no retaliation. But what we have today is not sustainable for the long run. And you know, people like JPMorgan, you know, we spend $700 million a year. I think we're very protected. But the system itself in total is not. And governments have to get their hand behind this, all of them. This won't be just one government. It'll be, you know, you kind of need a convention of cyber to get everyone on the same page.
And the other side of the coin on that is legal data leaking. If you want to take Facebook and Cambridge Analytica as an issue, you have tons of client data. Is there ever a point where you look at ways to monetize that, or is the protection?
No, we don't monetize client data. We use it for our own risk, fraud, marketing, but it doesn't go outside of the bank. And this is a huge issue, and it's not a Facebook issue, it's just an issue about data, the amount that's bought, sold, collected, stored, used. Very often when you use an app or you agree to the I agree button, you don't realize you agree that they can sell that data to anyone they want. So it's all over the place, and I think consumers, individuals are going to have the right, and government's going to ask for some rights to protect that. You know, Europe is probably ahead of everybody else. Yeah. And banks, and even when you give your bank passcode, you've given the right to those people to take that data too, which I think is a mistake. It doesn't protect you, it doesn't protect the bank. So we're working in a friendly way with people like Intuit and other people. Say, if the customer agrees to send the data, what are they sending? Do they know they're sending it? And they can and how it gets sent, and they can turn it on or turn it off. So the customer's in control.
I want to give you the last word on the whole Bitcoin thing because, of course,
I'm not going to speak about Bitcoin. I could care less. You guys waste too much time about it, and I'm not going to spend any of my time on it.
Warren Buffett said it's rat poison squared. Oh, well.
Whatever he says.